Welcome back. We have Carissa Dirado from Premium Mortgage. In continuing our series of mortgage products that are out there, we've covered a couple previously, government programs, FHA, the VA. Last week we did conventional. We're back to a government-backed program, the USDA loan. All I know about it is they talk about it for rural areas.
Yeah, you nailed it. It's a great program that I feel like is underutilized. USDA is a 0% down rural area mortgage product, and it's very specific to a single family home. You can't own any other property, so sometimes that takes some people out. Credit score wise, you do kind of have to be on the higher end. I tend to see for approval, but we can try for a lower credit score individual as well. And then I also have the maps available too. So if it's okay, I'd be happy to kind of dive in back into that loan program. Okay,
sure. I'm here to learn. I'm here to learn on
perfect.
This. All right.
That sounds good. So I'm gonna do screen share. I'll take a second.
Okay.
All right, we got this. So this is our handy dandy loan comparison sheet as same as before. And I'm just gonna do a zoom in so we can see the USDA here, and we're gonna be focusing on this USDA area. So as I mentioned, USDA is a 0% down. It does have private mortgage insurance, same as a government-backed loan. It has private mortgage insurance for the life of the loan, but actually the percentage is lower than FHA. So if we were to I don't know what way to go, USDA, the properties in the USDA area, well, USDA is 0% down plus the mortgage insurance. The private mortgage insurance is lower. So if we can go USDA, it might be a better option. Interest rates tend to run around the same roughly as well too. The kicker with the USDA is there's an income limit. So and I apologize, I've got my cheater notes here, but in the Buffalo, Niagara area, a household up to 4 people, you can make roughly about $88,000. That does change usually on an annual basis, but in the Allegheny, Chautauqua, Wyoming, Cattaraugus, it's roughly for up to 4 people, roughly about $86,000 per year. And there's a couple little nuances in there too. If somebody's kind of borderline, they ask some additional questions about medical and childcare expenses that we might be able to kind of move that number around a little bit. But the dollar amount annually that somebody can make for this program it's on the higher end. So it's a great program. And then with it, very specifically, can only be for a single family home, and you cannot own any other property, and they only do a 30-year term. There's no adjustments to that. The other nice thing about this program, if somebody is asset challenged, is the 6% seller's concessions. And I know we've touched on seller's concessions before, but this allows you to finance some of your closing costs into your mortgage. And so the example of, let's say, net to seller is $100,000 purchase price, or sorry, $100,000 net to seller. We can add in 6% seller's concessions, so $6,000. The purchase price would then be $106,000, and then we would take that $6,000 and back it out of the closing cost, no down payment. And in this case, somebody might actually come to the closing table with no money due. They might have just already paid their earnest money deposit, and that be that.
Closing costs typically run about 6% of the sale price, correct? Depending on what the taxes are in that area, right?
Yeah, sometimes it's just a touch less. There's quite often situations where I don't need the full 6% seller's concessions. Okay. And that interactive pre-approval system is nice in that regards because it lets us hone in right on the number needed for that sales contract. Yeah. So I did want to bring up on the screen share, if you don't mind, let's take a look at the eligible areas, because that's always an interesting thing to check out. There actually is a website. I literally just Google search USDA property eligibility, and this is the website somebody needs to get to. So we would do property eligibility. We would do accept, and it would allow somebody just to type in a very specific address. Now I have something already zoomed in for us, ready to go for the Western New York area. And so you can see this tan area here, if it comes through clear, this is the ineligible area, sorry. All these other areas here are actually eligible areas. So you and I both being from the East Aurora area, let's zoom in, you can see East Aurora is eligible. Another really neat one that people aren't aware of, Grand Island.
Well, even though it's rural, they say rural. villages and stuff, depending where they're located, they're eligible for these.
Yeah, yeah. So when I do pre-approve somebody, I look at options and I always ask, what areas are you most interested in? And if I know they're going to be interested in an area that might fall within it, we might look at a dual pre-approval, such as a conventional. And then if they happen to hit upon an area specifically that hits USDA, we might be able to follow through the USDA pre-approval too. So it's pretty common. In Hamburg, that's quite common. The Hamburg area is blowing up right now. So some parts of, southern part of Hamburg, as well to West Falls, Aurora. So there's a lot of areas that actually do hit the USDA. So it's a nice option. The only other thing I really wanted to mention is the appraisal. The appraisal process is very similar to all the other government-backed loans. Really just making sure there's no peeling paint, no missing hand railings. Those are kind of the big boys, but in general, they're not bad.
So what if someone had another product, a loan, an FHA loan on a previous house, they'd been there for 20 years, what have you, had some good equity involved.
Yeah.
Would they be able to purchase a second home with USDA?
Not a second home, but they could purchase a contingent home.
They'd have to be contingent on selling the FHA loan. Gotcha.
Yeah, you can only, USDA is very specific about making sure you only own one home at a time. And they also do not allow non-occupying co-borrowers. So we cannot be adding anybody else into the loan to try to make the loan work.
Gotcha.
Yeah,
okay.
They're great loans. I wish they were utilized a little bit more. Sometimes, you don't know what you don't know, but when we start asking the questions, sometimes it comes into play. So
exactly, that's why we send them to you.
Awesome, appreciate it.
All right. Take care, Carissa.
Thanks. Take care. Bye.
Bye.